Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture with me, Huang. So lots to talk about as we count down towards Liberation Day, and a lot going on with the potential for the tariffs to have an impact on global growth and inflation. So investors getting nervous. So what can they do to navigate the current backdrop? Well, it seems like one place is in TIPS, Treasury Inflation Protected Securities. And to walk us through how this works, we've got Daryl Ho. He is the Senior Investment Strategist for DBS Bank's Chief Investment Office. Daryl, good morning. How are you doing these days?
Hey, good morning, Ryan. Happy to be here.
Hey, great to have you on because I think a lot of people are keeping busy with all the headlines going back and forth. How has that been affecting markets going by what you've been observing?
Well, definitely the markets look a bit nervy. I think if you look at the year-to-date performances of risk assets, it would tell you the story that what initially was a lot of confidence in the revival of the American economy is now being throttled by a lot of threats of tariffs. So you're seeing accordingly, risk assets behaving in line with the uncertainty that's been put forward by President Trump.
That's right. So with all this uncertainty, there's now a bit more attention being paid to an asset called Treasury Inflation Protected Securities. Give us the lowdown of what are these asset instruments like? How do they work?
I mean, given the fact that, tariffs is unique because on the one hand, it's a drag to growth, and also it increases inflation expectations because it raises the price level of general goods and services, right? Goods especially. And so there is an instrument in the bond markets called TIPS, as you have said, that I thought caters very well to this and precise environment where growth is expected to slow, yet inflation is expected to remain sticky. So, how TIPS works is it's essentially like a bond, right? So it pays you a regular coupon, say 2%, but there is a component in a bond that adjusts for inflation. So there is an index ratio that matches with the CPI, which is the Consumer Price Index. And so the principal of the bond as well as the coupon both adjust with inflation. So I think you kind of get the best of both worlds, right? Not only do you get a regular yield, you get something that maintains your purchasing power, which is something that regular bonds does not do. So I think it's a very unique instrument for the times that we're in, and I think it's worth having a look at.
Yeah, so I guess it guards against inflation to some degree, also in some sense guarantees your capital. So does this always work? Do TIPS always guard against inflation going by past history? How have they performed in the past few years?
That's a great question, Ryan, because, in 2021, there were, a select investors who were quite keen to look at TIPS because, I think everyone kind of understood that if the economy started to reopen in 2022 after the vaccines, there would be some spike in inflation, right? So there were some investors who were looking at it then. We were not so confident because back then we knew that TIPS made sense as an adjustment mechanism, but its price was way too high to the point that it was actually a negatively yielding bond back then in real terms, right? And so the valuations back then were not interesting to us. And sure enough, in 2022, they suffered like the rest of the market with negative returns. But today, because the TIPS prices have dropped a bit, because the Fed obviously raised rates a lot, and that had the effect on bond prices, and TIPS is not dissimilar. And so today, when the yield component is a lot higher, the real yields today are north of 2% in certain aspects. And so I think that presents a really interesting opportunity now because the biggest headwind of Fed rate hikes is gone. The Fed is still communicating that they're cutting interest rates. And so I think the setup is very nice for this instrument because the headwinds are gone. What's looking ahead of us is inflationary or raises inflation expectations with tariffs. So you put all these factors together, it does make sense, right, that this instrument can solve a lot of the problems that we're seeing in the world today.
Yeah, so that's a good price or attractive price to look at these days when it comes to TIPS. Looking at the universe of options out there, though, when it comes to the potential to hedge against inflation, some might consider gold as another place to look at, especially when you look at the past few years. It has been performing quite well. In fact, it has hit record highs. How do TIPS compare to, for example, gold as an inflation hedge?
Ryan, again, a very interesting question. Right, so if I were to give you a little bit of history, right, before the year of 2022, the real yield on TIPS and gold prices were almost perfectly correlated. Right, perfectly negatively correlated. And so I think investors have always kind of looked at TIPS and gold as inflation protectors in your portfolio. something happened in 2022 that caused a big divergence where gold had vastly outperformed TIPS as an inflation protector since then, right? So it forced us to think about, as inflation protectors, yes, they look similar, but what are they fundamentally different about? And if you think about it, gold is a reserve neutral asset that central banks can buy, whereas TIPS is ultimately still a credit or it's a debt instrument of the United States government, right? And so it is a debt instrument after all. And so when investors are forced to think between the two, and when you talk about the credit of the United States, they just got downgraded in 2023. Everyone's talking about the fiscal situation being, a little bit difficult and escalating. And so I think the divergence is because ultimately investors were forced to think about whether they want to hold an asset like gold or a debt asset like TIPS. Right. So what we're trying to say today is that the yields on TIPS start to look interesting, right? The divergence has been high, yes, but ultimately gold does not pay you a coupon, right? It does not give you any dividend or regular cash flows. And so TIPS as an instrument does do that, because it's ultimately a fixed income instrument as well. So I think that the divergence has reached a point where actually generating a little bit of, regular payouts is starting to look interesting as well, on top of the fact that they would adjust with the consumer price index. I think there is some room to catch up, right, for TIPS to gold's performance over the past couple of years.
Yeah, I guess no yield, at least no coupon on gold. That's something to consider. Now, how about accessibility or liquidity when it comes to TIPS? How do investors get access to investing in Treasury Inflation Protected Securities?
I think just like U.S. Treasuries, it's a huge and deep market. So I think it is not difficult to get access. From what I understand, if you look at the markets out there, you can have access to TIPS with, various expressions in ETFs, which are generally very low-cost index type of funds. And so investors can actually have positions in these structures, without, having to pay an arm and a leg from management fees. And so I think that it's not difficult to get exposure because, the markets are quite well developed and this market is actually quite deep.
When you look at TIPS, they also come in durations. What sort of durations are suitable for the current backdrop?
If you look at the yield curve, the story of maybe the last couple of years is there is an inverted yield curve, which is recessionary. That's for the nominal yield curve, right? Nominal yield is the yield component that is paying you in nominal terms. That curve was inverted for the last couple of years. But if you look at a real yield curve, which adjusts for inflation, you will find that it's actually positively sloping and quite steep as well. And so we actually like longer duration TIPS, right? And this goes to 15 years and beyond because with such a steep real yield curve, I think you're getting very good compensation for the long term by taking duration positions in TIPS. So this not only positions you well for a rate cutting cycle, because as the Fed starts to cut interest rates, that would have a positive tailwind effect on TIPS as well, right? So the longer duration TIPS you hold, the more likely you get more aggressive price gains when the Fed cuts rates. So I think that these are a couple of things that look interesting, right? The yield curve is steep, right? You get higher yields on the longer end. And if the Fed does cut rates, you get some price upside as well.
All right. So in that sense, locking those rates and setting up for price gains on your instrument. We've been in conversation with Daryl Ho. He is a senior investment strategist for DBS Bank's Chief Investment Office, talking about why investors should look more closely these days at TIPS or Treasury Inflation Protected Securities. Daryl, thanks for your tips today.
Thanks for having me.
All right, great having you on. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.